Hey guys, okay, so we're gonna go ahead and start modeling out, pulling out our non-recurring items. So let's start with our cogs, okay? Now, like I said, I don't want you guys to kind of waste your time looking for information because I already found it for you guys. I'm just gonna point out the page number and where exactly did I get it from. Um, in cogs, after reading the 10K, you're going to find that on page, I believe, 19. Okay, Colgate tells us that there are 2004 non-recurring, restructuring program charges that we need to account for, and later on they say that this is non-recurring. This is just a restructuring program that happened for this particular these next past 3 years. So we need to take those amount and kind of count it in. So that means add it back to our expenses or pull out from our expenses. So what we're going to do is that I already have 3.4 and 100.2 over there, as we can see. So our 2006 is simply 196.2. 196.2. Okay? Now, our non-recurring stuff is going to be, well, since we said that in this particular model we're combining our SG&A and other expenses, as you can see, SG&A and other. So what we're going to do is we're going to add our SG&A and other together. So 46.1 plus 153, so 46.1, and we're going to have 153.1. 153.1. Okay, this is not final yet because we have to add other stuff. But as for this, I think this is final for now. Okay? Since we're already over here, how do we get our after-tax amount? Well, as we can see over here, it says yada yada program charges pre-tax, yada yada after tax. So it doesn't really tell us which portion of it is coming out of COGS, which portion is coming out of SG&A, which portion is coming out of other. So we have to make an assumption. And the assumption we're going to make is that the proportion of COGS or SG&A or other, okay, proportion out of the pre-tax of that particular item is going to be the same proportion in the after tax, okay? And we're just making this assumption because we don't have any information. So basically, 3.4 divided by 68.7 is the same proportion. We're assuming it's going to be the same proportion relative to the 48 after tax, okay? So let's try it with 196.2. Sorry, 196.2 divided by 395.4 to find that proportion. And then we're going to multiply by 286.3 to get our assumed information for our COGS. Okay, so let's do that. So 196.2 divided by 395.4. I'm going to put this in parentheses. Oh, sorry. Sorry about that. Okay. And then we're going to divide it. Then we're going to multiply by 286.3. 286.3. 286.3. Okay, and as you can see, we're saying that over here that, okay, the same proportion of the pre-tax is the same proportion of the after-tax. Therefore, we have 142.1 as our after-tax COGS non-recurring. Okay, so let's do the same for SG&A. Now, if you look closely to the SG&A, we added 46.1 and 153.1. Okay, so what we're essentially going to do is we're going to find the proportion of those SG&A and other together on the pre-tax level and multiply that for our after-tax to get that same proportion as well. So let's do that. So first let me put in these numbers: 46.1, 153.1. So I put a parentheses over here. 46.1 plus 153.1. And then I'm going to divide it by 395.4. 95.4. And then I'm going to multiply it by 286.3. and that's going to give me the proportion of my SG&A and other, and that will be after tax. Okay, so we got that portion done, and honestly that's probably the easiest part, because now we're going to get to a little bit more difficult thing. Now, okay, as we read through our 10K, we also find that on page 13 we have in our other income and expense. So what we looked at was our total restructuring costs. That's where that restructuring program we were talking about. Over here is more comprehensive, and it's talking more or less about the other income and expense that we need to look at. Basically, this portion is telling us, hey, by the way, in our other income and expense segment, these are the expenses that we're including. Okay, so we're looking at these expenses and additions, and we're seeing that some of these are non-recurring and some of these don't even belong here. Okay, so minority interest and equity income, we're gonna pull those out. Why? You're probably asking yourself, okay, why are we pulling these out when we have a separate line for them on the income statement? You're correct. You're totally correct. So what we're going to do, the reason we're going to pull these out is that we have to explicitly tell our model that, hey, this is a minority amount, this is an equity amount. Okay, so let's do that first. So we're going to pull out our minority amount for 57.5. Now, one thing to remember when we're with the non-recurring items is that whatever is a expense, such as minority interest, whatever is an expense, we're going to add that back in. Whatever is an income, we're going to subtract that out. Okay? So it's an opposite. So make sure you do that whenever you're playing around with these numbers. So minority interest is an expense, so we're going to add that back in. Plus 57.5. And then we're going to subtract our equity income, which is 3.4, as you can see here. 3.4. Okay, now what I would do at this point is that I have technically found my equity and my minority interest. So I'm going to take these numbers and I'm going to put them in my equity, income, and affiliates. Okay, so let's do that. I'm going to also do that for 06 and 07 as well. So our number was 57.5 for our minority. Our equity income is going to be 3.4, so we're going to put 3.4. And our minority interest is going to be 57.5, negative 57.5. Now you're going to be asking yourself, why did we switch this? This was a negative and now this is the positive. Well, in the 10K, it tells us in parentheses is an income. So that means whatever is in the parentheses over here is an income. What we did in our model is that we switched that. Okay, whatever is in parentheses is an expense over here in this particular segment. I want to make it emphasize why, the reason being that these are expense as well, but we don't put parentheses in front of them. Over here we are. Okay, so also pay attention to that when you're looking at this model. So let's do the same thing for 05, and then we're going to come back. We have to do other things to it as well. So negative 55.3. We're going to do negative 47.9. And we're going to do 2. So we're going to put 2. And then we're going to put we're going to put 8.5. Okay, now we are not done with this yet, with this segment, and reason being is because our taxes, whatever is after the tax, we need to tax affect it. Okay, so these two we need to tax affect. So what do I mean by tax effect? We're essentially going to take our equity income and our minority interest, we're going to multiply it by 1 minus whatever is our tax rate for that particular year. And for convenience, I have put it up over here, so it's going to be 0.337, close. Oh, let me first put it equal so it actually calculates it. There. Okay? We're going to do the same for 1 minus 0.35, and this is tax deductible. Okay, that's why we're doing this. Right, expenses tax, equity income and minority interest is tax deductible. Therefore, we need to put a tax shield. So how do you tell if something is tax deductible or not? Well, interest expenses. Besides that, I don't think anything else is instead of after the taxed. Okay. So what I'm trying to say is that, okay, we put these numbers in. Okay, we put the regular numbers in, right? We put these numbers in. The problem is that these are not net of taxes. These are not tax affected. That means they are not taxed yet. So we need to tax them. That's why I'm doing this. Okay? So let's do it for 3.4 as well. And we're going to use 1 minus 0.324. I gotta remember to put an equal sign in front of these. And we're going to also do the same for our minority interest as well. So 1 minus 0.337. Make sure you put a parentheses. Equal sign. And equal sign. Multiply by 1 minus 0.35. There. And we're going to put multiply by 1 minus 0.324. There. Okay? So we have this. And there you go. So we're done with the equity part. So, I'm running out of time, so I don't know if I should do this. Okay. So I added these in. Okay. So I showed you. Okay. I don't know why it's in there. Alright. Okay. What I'm going to show you guys is how do I figure out which one is minority and which one is not. Apparently I actually put in the numbers 46.1, 153.1. Okay. Alright. So what I did right now was I added back minority interest and I subtracted out equity income. And the other non-recurring items, which are always non-recurring, is your gains on sales. Obviously, they have told us that this is non-recurring, our restructuring program, which is 04 and 03. Our outstanding pension or other retiree benefits, these are non-recurring. And there you go. So what we're going to do, we're going to play around with these, add them or subtract them depending on what kind of asset they are, what kind of expense they are. And we're just going to do it like the way we've been doing it. So the next one in line is gains on sale. Obviously, gains mean that we have a plus. So we sold our assets and we brought the money in. We're going to subtract that, right? Because that is not normal income. We don't get that on a day-to-day basis. So we're going to subtract out 46.5. Okay? What else we're going to do is we're going to 2004 restructuring program, this is already in there. Okay, we already taken it from the couple pages in front. If you don't believe me, let's look at, you will see 153.1. This is already suggested or listed into the couple pages that we were at. So we don't have to worry about that. No 2003 restructuring activities. Pension retirees, none. Investment losses, don't have to worry about that. Other net, we don't have to worry about that. There we go, so we're done. Alright, so we're done with this portion. Okay, now we're going to worry about our taxes, which is a little bit harder. But I found a way to make it easier for you guys. Essentially, we're going to take all of this, okay, all of this except what's already in here. Okay? What do I mean by that? Okay, what do I mean is that you see 46.1 and 153.1. What we did was we taken a weighted average of it, and these are actually our restructuring costs, right? Well, we already have restructuring costs in here, 46.1, 153.1. Okay, so when we're going to copy this whole thing, we have to get rid of these two, or else we will be double counting these. Okay, so let's do that. We're going to copy, or we can just copy. Well, actually, let me just copy these so I can make a point. Why am I doing what I'm doing? Go over here, and what I'm going to do, I'm going to put plus, parentheses, Control V, close parentheses. Okay, so I'm going to go back and I'm going to get rid of my 153 and 46.1, which you can see I've double counted over here. So that's what I'm going to do. And there. Now, we have to tax affect these, right? Because we're finding our after-tax proportion. So what we're simply going to do is that we're going to multiply by 1 minus our tax rate, which is over here, 0.324. And that is done, okay? So we're done with that part. But we have one more thing to worry about. Crap. Now, over here, we're going to get rid of our 46.5, okay? Now, why are we doing that? Our 46.5 is what? Our 46.5 is our gains on sales. Why are we getting rid of that? Well, they have given us the amount of tax that's going to be in here. Okay, so let me tell you what I mean. We actually found the information of how much tax do we have. Tax amount of gains on sales do we have? I just need to hunt it down. Gains on sales. I have that. Gains on sales, certain brand, income tax expense, incremental. Not here. Gains on sales. Okay. Let me take a look at something. Okay, and this is just from reading the 10K, you're going to find this information. And here what we have is that net income including 38.2 gains of sale. Okay, this is our taxed amount of that gains of sale that we were talking about. How do we know this? Well, diluted, compared, issued, yada, yada, yada. Net income in 2006 included 38.2 of gains of sale of household bleach business. That's the same one that we're talking about, which was more than offset by 286 of charges related to blah, blah, blah. 48.1 and restructuring point, it was stock-based compensation, yada, yada, net income. Okay, let me see if there's a much more clear reason why we're doing that. Over here, yes. Transaction closed in Canada during the fourth quarter of 2006, which proceeded of 55.0 and a pre-tax gain of 46.5, 38.2 after tax. So they gave us our after tax amount, so we don't have to worry about that. So we can get rid of our gains on sales as well, and then we can just on the side right here, we're just gonna add 38.2. Okay. All right. So we're almost done. I'm just gonna cut it off over here, and we're gonna go back, and we're gonna worry about the stock-based compensation expense, and then we're gonna flow everything through our income statement. All right. Catch you later. Bye.